NBIS, could it become the next AI infrastructure giant? What is Nebius? NBIS is much more than a company that rents GPUs. Nebius is building an AI-native cloud infrastructure platform designed specifically for artificial intelligence rather than adapting a traditional cloud platform like AWS or Microsoft Azure. Here's what the company actually does. Nebius owns and operates AI data centers filled with thousands of NVIDIA GPUs. Instead of companies buying these expensive GPUs themselves, they rent computing power from Nebius. Customers use this infrastructure to train large language models, fine-tune AI models, run AI inference, build AI agents, process huge data sets, and power image, video, speech, and coding models. To provide this computing power, Nebius does not simply lease data center space. It designs, builds, and operates AI-optimized data centers around the world. These facilities include NVIDIA GPUs, high-speed networking, massive storage systems, liquid cooling, power infrastructure, and AI-optimized server racks. Nebius also designs much of the infrastructure that powers these systems, including server architecture, rack layouts, networking, cluster management, resource scheduling, and deployment software. That matters because AI workloads are different from normal cloud workloads. Training and running AI models requires massive GPU clusters, fast networking, strong cooling, and extremely efficient infrastructure. The hardware is only part of the business. Nebius also provides software that allows developers to create GPU instances, launch clusters, store training datasets, train models, monitor utilization, scale workloads, and deploy AI applications. This allows customers to focus on building AI while Nebius manages the complex infrastructure underneath. Another major part of the business is AI inference. Training a model is only the beginning. Once a model is trained, it has to answer real users. That is called inference. Examples include AI chatbots, AI image generation, AI coding assistants, AI search, and voice assistants. Inference can run continuously, creating recurring demand for AI infrastructure providers like Nebius. Nebius serves more than AI startups. Its customers can include companies building AI for healthcare, finance, robotics, media, scientific research, and software development. Many enterprises lack the capital or expertise to build their own AI infrastructure, so they rent it instead. Nebius also works closely with NVIDIA, giving it access to advanced AI hardware and helping it build infrastructure designed for next-generation AI workloads. Nebius makes money when customers pay to use its AI infrastructure. That includes GPU rentals, AI cloud services, storage, networking, managed AI services, enterprise AI infrastructure, and inference workloads. The more customers train, deploy, and run AI models, the more computing resources they consume, and the more revenue Nebius can generate. A simple way to understand it is this. Imagine you want to build the next ChatGPT. You would need thousands of NVIDIA GPUs, a data center, cooling systems, high-speed networking, storage, and engineers to keep everything running. Building that yourself could cost hundreds of millions or even billions of dollars. Instead, you rent that infrastructure from Nebius and start building immediately. 2023, the reset year. In 2023, Nebius was still in its reset phase before becoming the AI cloud infrastructure company investors follow today. Revenue was $20.9 million. Net loss from continuing operations was $336.6 million. Adjusted EBITDA loss was $282.8 million. This year matters because it gives investors the baseline before Nebius began scaling aggressively into AI infrastructure. The key obstacle was the Yandex separation and corporate restructuring. Nebius still had to prove it could become an independent, investable company with a real AI infrastructure business. 2024, the transformation year. In 2024, Nebius became a real AI infrastructure story. Revenue increased to $117.5 million, up 462% year over year. Net loss from continuing operations was $396.9 million. Adjusted EBITDA loss was $266.4 million. Nebius ended 2024 with $2.45 billion in cash and cash equivalents. In November 2024, Nebius launched its first U.S. GPU cluster in Kansas City, Missouri. In December 2024, Nebius announced plans to deploy more than 22,000 NVIDIA Blackwell GPUs in data centers in the U.S. and Finland during 2025. Also in December 2024, Nebius raised $700 million through strategic equity financing from investors including NVIDIA, Accel, and Orbis managed accounts. This mattered because Nebius needed massive capital to buy GPUs, expand data centers, build cloud infrastructure, and prove it could move beyond restructuring. The financing strengthened the company's balance sheet and accelerated its ability to scale AI infrastructure. 2025, the scale-up year. In 2025, Nebius moved from transformation to scale. Revenue reached $529.8 million, up 479% year over year. Fourth quarter revenue reached $227.7 million, up 547% year over year. Annualized run rate revenue reached about $1.25 billion by the end of 2025. Nebius had previously raised its 2025 ARR guidance to $900 million to $1.1 billion, so ending near $1.25 billion means management beat that guidance. The biggest customer milestone came in September 2025, when Nebius announced a multi-year, multi-billion-dollar agreement with Microsoft. Under the official agreement, Nebius will deliver dedicated AI infrastructure capacity to Microsoft from its Vineland, New Jersey data center. According to Reuters, analysts estimated the Microsoft agreement to be worth approximately $17.4 billion, with the potential to expand to around $19.4 billion. Nebius itself described the agreement only as a multi-year, multi-billion-dollar AI infrastructure contract and did not disclose an official dollar amount. By the end of 2025, Nebius had around 170 megawatts of active power and more than 2 gigawatts of contracted power, positioning the company for a larger 2026 infrastructure ramp. The key obstacle in 2025 was execution. Nebius had to scale fast enough to serve hyperscaler demand while funding billions of dollars in infrastructure spending. 2026 Contract Visibility Year. In 2026, Nebius became more than a fast-growing AI infrastructure story. It became a contract-backed AI infrastructure story. Nebius guided for $7 billion to $9 billion in annualized revenue run rate by the end of 2026. In March 2026, Nebius announced a major 5-year AI infrastructure agreement with Meta. Under the official agreement, Nebius will provide $12 billion of dedicated capacity across multiple locations based on one of the first large-scale deployments of NVIDIA's Vera Rubin platform, starting in early 2027. Nebius also said the total agreement could reach approximately $27 billion over 5 years, including the dedicated capacity plus additional capacity arrangements. According to Reuters, NVIDIA invested approximately $2 billion in Nebius, acquiring an estimated 8.3% ownership stake. The key obstacle in 2026 is no longer proving demand. The challenge is funding, building, and delivering enough AI capacity without overextending the balance sheet or creating too much dilution. From 2023 to 2026, Nebius went from $20.9 million in revenue to a company with major AI infrastructure agreements involving Microsoft and Meta, backing from NVIDIA, billions in infrastructure spending, and a target of $7 billion to $9 billion in annualized revenue run rate by the end of 2026. Financial Deep Dive. Nebius is growing extremely fast, but this is still a very capital-intensive business. In 2024, revenue was $117.5 million. Cash outflow from operations was $319.6 million, and capital expenditures were $808.1 million. That means Nebius was spending heavily before reaching scale. In 2025, revenue reached $529.8 million. According to StockTitan's financial summary, Nebius reported an estimated gross margin of about 68.6%, operating cash flow of approximately $384.8 million, capital expenditures of roughly $4.1 billion, and free cash flow of approximately negative $3.7 billion during 2025. That shows the core business improved, but infrastructure spending remained massive. By Q1 2026, Nebius ARR reached $1.92 billion, up 674% year-over-year and 54% quarter-over-quarter from $1.25 billion at the end of 2025. Management. Nebius is led by Arkady Volozh, founder and CEO of the company. He previously served as CEO of Yandex and resumed office in 2024. Nebius describes him as a serial entrepreneur with a computer science background who founded or helped build companies including Comptech, Infinet Wireless, and Yandex. Management has executed well so far, successfully guiding Nebius through corporate restructuring, NASDAQ trading resumption, strategic capital raises, global AI infrastructure expansion, and major commercial agreements with Microsoft and Meta. Capital raises and dilution risk. In 2025, Nebius announced a $1 billion private placement of convertible notes, split between $500 million of 2.00% notes due 2029 and $500 million of 3.00% notes due 2031. In September 2025, Nebius priced an upsized $2.75 billion convertible senior notes offering, split between $1.375 billion due 2030 and $1.375 billion due 2032. In March 2026, Nebius priced an upsized $4.0 billion convertible senior notes offering, split between $2.25 billion due 2031 and $1.75 billion due 2033. These financings demonstrate management's willingness to raise significant capital in order to scale rapidly. While this accelerates infrastructure expansion, investors should monitor future dilution and debt obligations if additional financing becomes necessary. Institutional ownership. According to Fintel, Nebius has 352 institutional owners holding about 132.6 million shares. Major holders listed include FMR LLC, Situational Awareness LP, Harding Loevner, UBS Asset Management, Schroeder Investment Management, Capital International Investors, and State Street. According to MarketBeat, current institutional ownership is about 21.9%, with 545 institutional buyers and 190 sellers over the last 12 months. MarketBeat reports institutional inflows of about $5.36 billion compared with outflows of about $2.30 billion. Competition. Nebius competes against traditional hyperscalers like AWS, Microsoft Azure, Google Cloud, and Oracle Cloud. It also competes with specialized AI infrastructure companies like CoreWeave, Lambda, Crusoe, and FluidStack. The reason Nebius still has a chance is specialization. Unlike traditional cloud providers that serve many different workloads, Nebius focuses on AI training and AI inference, allowing it to optimize infrastructure specifically for large-scale GPU computing. It is trying to build AI-first infrastructure optimized for GPU clusters, high-speed networking, liquid cooling, and massive AI workloads. Moat. Nebius's moat is not one single thing. It is a combination of AI-focused infrastructure, large GPU deployments, power access, data center expansion, vertical integration, its NVIDIA relationship, and major customer validation from Microsoft and Meta. Rather than relying on one competitive advantage, Nebius is building its moat through infrastructure scale, customer relationships, power availability, and vertical integration. However, investors should recognize that this remains a high-risk, high-reward investment requiring substantial capital, disciplined execution, and continued demand for AI computing. The moat is still developing, but if Nebius keeps securing power, GPUs, customers, and capital faster than smaller competitors, it can become harder to replicate. Risks. The biggest risk is capital intensity. Nebius needs billions of dollars to buy GPUs, secure power, build data centers, and scale infrastructure. The second risk is dilution. Convertible notes and equity raises can help fund growth, but they may reduce shareholder ownership over time. The third risk is customer concentration. Microsoft and Meta are huge wins, but depending too much on a few hyperscaler contracts can become dangerous. The fourth risk is competition. AWS, Azure, Google Cloud, Oracle Cloud, CoreWeave, and other AI cloud providers are all fighting for the same AI infrastructure demand. The fifth risk is execution. Nebius has to build massive infrastructure on time, secure enough power, deploy GPUs efficiently, and maintain high utilization. Another major risk is return on invested capital. AI infrastructure demand can stay strong, but if Nebius spends too much to generate that revenue, shareholders may not see enough long-term free cash flow. Bull case. The bull case is that Nebius becomes one of the leading independent AI infrastructure providers in the world. Revenue is growing extremely fast. ARR is scaling rapidly. Microsoft and Meta validate demand. NVIDIA's involvement adds credibility. And management is guiding for $7 billion to $9 billion in annualized revenue run rate by the end of 2026. The strongest version of the bull case is that Nebius successfully converts long-term customer agreements into recurring revenue, keeps utilization high, expands power capacity, and eventually generates meaningful free cash flow as the business scales. Bear case. The bear case is that Nebius grows revenue quickly but never generates enough free cash flow to justify the spending. If capital expenditures keep rising, dilution increases, major customers slow orders, or competitors undercut pricing, the stock could struggle even if revenue keeps growing. Another key risk is that AI infrastructure demand could remain strong while returns on invested capital lag because of heavy financing costs and constant infrastructure spending. Final thesis. Nebius is not a safe, mature infrastructure company yet. It is a high-growth, high-capex AI infrastructure bet. The upside is that Nebius could become a major AI cloud provider backed by hyperscaler contracts, NVIDIA-linked infrastructure, and rapid ARR growth. The downside is that the business requires enormous capital, carries dilution risk, and depends on strong execution. If management continues executing at its current pace, Nebius has the opportunity to become one of the world's leading independent AI infrastructure providers.